Hi, I'm Noah Solomon, Chief Investment Officer of Outcome Metric Asset Management, and today I'm here with our VP of Client Engagement, Beth Philp, and we're going to talk about why, contrary to popular belief, time does not heal all wounds when it comes to investing. Imagine if tall parents only ever had children that were taller than they were, and similarly, shorter parents only ever had children that were shorter than they were. Well, if you continue this pattern generation over generation over generation, then eventually you're going to be left with a society composed of nothing but giants and elves.
No, I love that story, but I'm curious, what does this have to do with investing?
So what I'm talking about is reversion to the mean, the tendency of something to revert to its long-term average over time. Kind of like a pendulum, which can swing out one way and swing out another way, but over time it always comes back to the middle. So we see reversion to the mean in all walks of life, including financial markets. In financial markets, we use the term cycles, which basically describe reversion to the mean. Bull markets are followed by bear markets, and bear markets are followed by recovering bull markets, etc. Periods of several years of better than average returns are typically followed by worse than average returns and vice versa. But importantly, reversion to the mean is the underpinning of the buy and hold approach to investing. And the buy and hold approach to investing is the way the vast majority of investment managers manage their clients' portfolios. Chances are, if you have an investment manager, they are following a buy and hold approach to manage your money. So let me describe what buy and hold is. It basically means they don't make any significant changes to the asset mix of your portfolio. So for example, if your portfolio consisted of 60% weighting in stocks and a 40% weighting in bonds, that mix typically doesn't get changed very much by your investment manager, regardless of what is happening in the markets. Through thick and thin, you stay at that mix of 60% stock, 40% bonds. So regardless of whether you are in the throes of the horrible bear market of the 2008 global financial crisis or the rip-roaring recovery of late 2009, you more or less stay at that 60-40 mix. Why? Again, reversion to the mean. The thinking is that you should just sit tight through the massive ups and the massive downs and ride the roller coaster, because over the long term, you'll have reversion to the mean. Everything will come out of the wash. So sit tight and don't worry, because you'll all wind up in the same place over the long term anyway. So at Outcome, we believe you shouldn't just take into account averages, but also how variable things can be. For example, something that has an average of 10 but can range between 8 and 12 is a very different animal than something that also has an average of 10 but can range from -20 to +40. Those two are not the same thing. So the problem with investing based on averages without regard for how variable things can be around that average reminds me of the old statisticians joke about the man who has his head in the oven and his feet in the freezer. On average, he feels just great. So I do believe in reversion to the mean. I believe it certainly has occurred and it will occur, but I don't believe in it enough to justify exclusively buy and hold investing, doing nothing through thick and thin on the belief that everything will be okay in the long run and then you'll all wind up in the same place at the end of the day. What this table shows is an actual example, and what the table contains is the returns of the S&P 500 index in the post-war era between 1945 and 2000. And what I've done is I've taken 1-year holding periods, 10-year holding periods, and 30-year holding periods. And specifically, as you can see, I've taken the worst, the best, and the difference between the best and worst in each holding period. So looking towards the left under 1 year, the best 1-year return for the S&P 500 in the post-war era was 56.3%, a banner year. On the other hand, the worst single year during that time frame was -41.2%. So there's a difference of 97.6% from the best to the worst. Now let's move a little bit to the right to 10-year holding periods. The best 10-year annualized return in the post-war era was 18.8%. The worst was negative 5.9. So the spread is 24.7, the spread between best and worst annualized returns. So just from going from a 1-year holding period to a 10-year holding period, the difference between best and worst annualized return has gone from 97.6% down to 24.7. In other words, 3/4 of that high-low spread has been eliminated. Now let's take it even further to the 30-year holding period. Now the best annualized return over 30 years was 8.9%, and the worst was positive 4%. So the spread between best and worst has now fallen to only 4.9%. So as the table shows, the difference between best and worst annualized return clearly falls the longer your holding period gets. In other words, reversion to the mean is indeed alive and well.
So if reversion to the mean is alive and well, aren't you making an argument for buy and hold investing?
Well, no, because it's a question of magnitude. Just because reversion to the mean is alive and well, it's not alive and well enough to justify doing nothing, sitting pat through thick and thin, and riding the roller coaster of the markets through good and bad. And I can explain why. So this table is the same as the previous table, but instead of looking at percentage returns, we're looking at dollar returns. Because of course, you don't eat percentages and you don't retire on percentages, you retire on dollars. So imagine you'd invested $1 million. If you happen to experience the worst return that the S&P 500 index has experienced in the post-war era, that $1 million would be down to $587,000. On the other hand, if you were lucky and you had the best experience you could have had, the best year in the post-war era, that $1 million would be $1,563,000 for a spread of $975,000. Again, remember that spread in annualized returns between best and worst, when you go from a 1-year to a 10-year holding period, falls from 97.6% down to 24.7. So you figure it's getting better, but not in dollars. So going to 10 years, if you invested $1 million for 10 years and you were unlucky and you had the worst 10-year holding period in the post-war era, the $1 million would be down to $542,000. On the other hand, if you had the best 10-year return, the $1 million would be worth $5.6 million. So the spread doesn't decrease. The spread between the value of that $1 million between best and worst goes from a difference of $975,000 at the 1-year period to over $5 million between best and worst at the 10-year holding period. Now let's move to 30 years. And remember, when you went to 30 years in the previous table, the difference between the best and worst annualized returns over 30-year holding periods in the post-war era was only 4.9%. But let's move to dollars. If you invested $1 million and you experienced the worst 30-year annualized return, then that $1 million would be worth $3.2 million. On the other hand, if you were lucky and you experienced the best 30-year return that we've had in the post-war era, it would be $12.8 million for a whopping difference of about $9.5 million. So imagine there's a difference in the value of your portfolio over a 30-year holding period, that's long term, of about $9.5 million on a $1 million investment. That is tremendous. So depending on when you invested the $1 million over a 30-year period, it could be worth as little as $3.2 million or as much as $12.8 million. That's a difference of $9.5 million between best and worst 30-year holding periods on an investment of only $1 million. In other words, the everything will be all right because you'll wind up in the same place over the long term, which is the basis for buy and hold investing, certainly has not been the case in the post-war era. So like other investment managers, at Outcome, we hope for the best. But unlike other investment managers who use buy and hold investing, we also plan for the worst. We offer strategies that tactically adjust our portfolios to increase our participation in rising markets so we can make gains in good markets while becoming more defensive in bear markets to protect our clients from large bear market losses. So for example, our machine learning based models dictated a defensive stance in the fourth quarter of 2018. So when stock markets went down roughly 20%, we didn't lose any money in our tactical strategy because we had gone to a defensive posture. We had liquidated all stocks and we were safe. Similarly, in the COVID crisis in March of 2020, when stock markets crashed about 30%, our models had dictated a similarly defensive stance, and we lost 2.9% in a month when stock markets went down 30%.
So Noah, what you're describing actually sounds an awful lot like market timing, and I didn't think it was possible to pick tops and bottoms.
It depends how you define market timing. If you define market timing, as you said, the ability to pick exact tops and bottoms and turning points in markets and get in at the very bottom and get out at the very top, that can't be done. I've never seen it be done successfully. We're not trying to do it at Outcome. It simply can't be done. But that's a bit of a straw man argument. That's like saying if you can't win the gold medal at the Olympics, then you shouldn't run. The question is not whether it's perfect. The question is whether it's better than the alternatives, in this case, better than standard buy and hold investing. So again, we're not market timing. We're not trying to pick exact tops and bottoms. We're simply trying to capture the majority of the move on the way up in bull markets, not all of it, because then you'd have to get in at the exact bottom and get out at the exact top, market timing, while avoiding the majority, not all, of the move down in bear markets. If you can do that, that will lead to outperformance over time. And in that way, our clients don't have to have their head in the oven or their feet in the freezer. And they also don't have to hope that during their investment career, they don't have to be lucky and happen to get a good period instead of a bad period. Thanks for watching. If you want to learn more about outcome metric asset management and our investment strategies, please visit our website at outcomewm.com, where you can receive our contact information and sign up for our monthly newsletter.